Good evening and welcome to Money Matters. My name is Pat Welde with Merrill Lynch. I have two co-hosts this evening. I have Mr. Paul Mitchell, Senior Loan Specialist from Republic Bank.
Good to see you.
And Mr. Richard Sichel, who's the Chief Investment Officer of Philadelphia Trust Company. Richard, welcome as well.
Thanks, Ben.
We're going to talk about lots of things tonight. We're going to talk about the economy. We're going to talk about business activity locally and abroad. And we'll also talk about the markets. So, let's introduce some of our guests. Richard, why don't you tell us a little bit about your firm, your strategy?
Happy to do it. The firm is called the Philadelphia Trust Company, clever name, and was formed in 1999. The name was available, so we liked it.
Sure.
We're a money manager. We have trust powers in Pennsylvania and New Jersey, but we manage all kinds of money. So people say, who's your best clients? Anybody who has money. Stocks and bonds with a style that's called growth at a reasonable price on the stocks. So high quality and just a lot of attention to detail, a nice track record, and we hope happy clients, institutional, and like pension plans and such, and endowments, foundations, and individuals.
Okay.
And been there since the company was formed back then in '99. I'm the Chief Investment Officer, and we have 20-something employees and about $2 billion under management.
Terrific. Well, welcome. I'm sure we're going to get some insight about your thoughts and opinions as well.
Good.
Paul, why don't you tell us a little about Republic Bank, what you're doing at Republic, how you can help some of our viewers.
Absolutely. Well, Republic Bank is not the smallest bank, and certainly not the biggest bank. It's about almost $1 billion in assets. Been around for 25 years, based in Center City, Philadelphia. 13 branches in the Center City and suburbs, a few over in New Jersey. We focus on the small business and sort of lower end of the middle market. Okay. So we were talking to a company that had $100 million in revenues. That'd be pretty big for us.
Right.
So a few $1 million in loans is sort of we're very comfortable with, and we finance all kinds of companies, technology companies, manufacturing companies, distributors, and nonprofits as well.
Okay.
We like to say that we'll listen to a story. So our box is pretty big. If it makes sense, it's based around Philadelphia. We'd like to see if we can help the business, help the organization.
Now let me ask you a question. Let's switch sides about your customer base, or everybody needs banking services. How do you perceive the perception of your client base and customers about banks? Because a lot's happened in the whole banking world in the last 10 years, 20 years. Yeah. And I'm curious as to what your perception of their perception. Yeah.
Well,
that makes sense.
Well put.
I've been in banking for a few decades, so you've different perceptions over the decades. Changes. And I'd like to say I think we're back to where we should be in banking. Kind of banking I learned in my early days. But I would say that first of all, you said everybody needs a bank. Well, just everybody has a bank already. In fact, I was talking to somebody yesterday that I was at a networking reception, and she said, "Well, I'm happy with my bank because I'm not looking for a bank." And then after talking for a few minutes, she said, "Well, maybe we can get together."
Right.
So that's part of it. I mean, if you're really unhappy, you're looking, or you found somebody else.
Sure.
But it's a very personal type of business. I mean, essentially, banks to most businesses, to most people, they all look the same. They have money. They pay low interest rates right now. They charge higher rates for loans. They don't make all the loans that people ask for. So there's a perception that the banks aren't doing enough to maybe help businesses or help consumers. On the other hand, banks have an obligation to fulfill their mission, which is to protect their depositors' money, let alone the fact that they're subject to significant regulation, as well they should be.
Back in 05, 06, 07, they were lending to everybody, whoever came in the door.
Right, and doing other kinds of things that were sort of related to banking.
Yeah, right.
It had to do with money. The banks
we do that. Yeah, we do that.
That's right.
Well, how about on the investment side? Let me turn to Richard. Obviously, last year was a terrific year for the stock investor, not so much for the pure bond investor.
Correct.
Let's talk about why do you think last year was such a good year for stock returns?
Yeah, I think it surprised everybody. I mean, early in the year we were bullish and said the market might be up 12, 13, 14%. That would be great.
Sure.
Things are improving, and we'll be all right. Market was up twice that, so that's a surprise. It's okay.
Good surprise.
But it was one of the best years, in 17, 18 years for stocks, and one of the worst years for bonds.
Yeah.
And that was, the bond thing really was, you're getting low rates. Some people are going out longer maturity, try to get a better rate.
Right.
And then the Fed started rumbling about tapering, which I don't think is a bad thing to, give us a little less of a crutch and let the economy grow.
Right.
But bonds got hit, and I think some people have thought, hey, I didn't think bonds could get hit. They did.
Yeah.
And I was telling you, the best stock I could buy for you today, it could go down 5 minutes later. We're long-term investors, and we'll give it time. But you don't want to have any problems with your bond. You want to keep the value as close as you can, keep them relatively short.
Of course, if you hold a bond to its maturity,
with time and patience,
you
will
get the return that says you're going to get.
I'm
Right.
glad you brought that up
Yeah.
because I think that's important for our viewers. And I, believe me, have been counseling lots of people in the last 2, 3, 4 years as we're approaching a year like 2013 for bonds and what may happen in 14 and 15, should rates continue to rise, is do you own the bond? Because most of our viewers, I'd argue, do not own the bond and can't wait till maturity. They own bond mutual funds. And I think people need to understand they're very, very different. And in a fund, other people's bad behavior impacts you, and it's a permanent loss. But you're right. If you own the bond, you can wait till the bond comes back.
Unless it's a
Do
30-year
you own the
bond,
bond?
you might
Yeah,
not want to wait.
that's a long
we
time.
try to keep bonds intermediate, 3, 4, 5 years. And as I would say too, if a 5-year bond, 2 years from now, rates are moving up. Okay, now it's a 3-year bond, and almost no matter what happens, your principal is going to stay around there. But if you're in a long bond or you're in some kind of a fund and you really don't understand what's in it, then you can have problems.
Sure.
And the main thing that drove stocks last year, and I don't want to take too much time, but I say the market went up in spite of everything that goes on in Washington. I think the Fed has done a very good job. Everybody else in Washington, we're not so sure about. So with sequester and fiscal cliff and all these silly things, the market went up.
Right.
And basically, earnings drive the market, and earnings have been good. Corporate earnings, U.S.-based companies have been good. There's
And
a
those
lot
earnings,
out.
those earnings obviously, come from lots of things. Some of it has been from balance sheet repairment, which has been fantastic. I mean,
Productivity.
So what is balance sheet impairment, repairment? What does that mean?
I think our viewers would understand it very simplistically. When many of our viewers may have refinanced the largest debt they have, their primary mortgage, 2 or 3 times in the last 7 years, and each time they do it, to their little household, 123 Main Street, it's really important. It saves them money this month and next month and the month after.
And they got great deals.
Well, think about if you are a corporation with a $50 billion balance sheet, the refinancing they can do. Corporations have got a chance to take any debt that's maturing in the next 5 to 10 years in some cases and roll it out to 20 years at lower rates than they were paying on the short stuff. It's unbelievable, which is why cash flow of these companies is so great, and that's permanent cash flow.
Yeah. Well, there's an area that I get a little skeptical about, and I'm not an expert in this area, but what I sort of read about and have a sense of is a lot of this increased earnings is from expense reduction, and that's kind of
Interest expense.
you're talking.
That's one kind of expense.
Yeah.
As opposed to growth in general, the kind that really adds employees and that type of thing.
And it's the top line growth that has been missing. The revenue, sales and revenue, it's been don't hire, cut here, cut here. It's not the best growth in the world. The cleaner, better, more sustainable growth would be, hey, sales are up, things are good.
Because if the stock market has reached all-time highs,
Right.
how come the economy doesn't seem to be just as robust as we could ever remember?
Let me dig in and ask you, because you speak to what I would call the engine of the economy, small business owners.
Yeah.
That's your lifeblood.
Right.
They're the lifeblood of the economy, quite frankly. What do you see with your own client base? Are they hiring? Do you see any hiring? Are they thinking about hiring?
Well, a little bit, and fortuitously, I was doing some reading before this program, and I read about a publication, some research done by, I think it's the National Federation of Independent Businesses. So they survey their members, thousands of members, and one of the main questions they ask are about employment. Have you hired more people? What are your plans for hiring people in the next 6 to 12 months, and that type of thing?
Sure.
And the results of the survey were positive, I hesitate when I say positive because it's like,
Right.
yeah, the growth was there, like maybe 1% for the last quarter.
Yeah.
On the other hand, what are your plans for hiring in the near future? Pretty minimal.
Yeah.
At least it's going in the right direction.
Yeah. Yeah.
So that's
it's not
that's
worsening,
good.
and that
Yeah.
and that is improvement.
And
Right.
that goes back to their ability to get financing too, because as their business improves, they're reluctant to add on expenses. Okay, until they really know it's
Sure.
happened, and they're like screaming for more help.
Yep.
To support their increased business.
Yeah, when times were so bad in '08, that's what you get. Where decades ago it would be, hey, things are improving a little bit. Let's build a plant. Let's hire 500 people,
Yep.
Yeah.
and pay them whatever they want. Give them cost of living raises and dental insurance and everything. Decades ago, and then the companies weren't productive,
Right.
and they've learned. So that's one of the reasons that unemployment comes down so slowly.
Yeah. One of the questions I have for you guys, you're professionals, and the Obamacare thing. When we bring it up, from time to time,
Yeah.
there always seems to be new iterations of it. So what's the latest sort of viewpoint from, let's say, from your customers,
Yeah.
your business owners, your investors?
I'll start, Richard. I
Sure.
would tell you this: from the people that I speak to, and I have lots of business owners as clients, nobody knows. Nobody really yet understands, the impact of this. Now, I will tell you, I think the very first impact of this, people are going to see within the next 100 days when they go and file their tax returns, because this is not new news, but I think for many it's going to be. When they quote unquote snuck in that extra 3.9 tax, which they're calling the Obamacare tax. Importantly, it has nothing to do, the money is not going for Obamacare. It's kind of like nobody knows where it's going, but people are going to pay it. And they're going to see that, and I think many are going to be angered by it. As far as the actual cost of the health care, the answer that I'm overwhelmingly getting is nobody knows.
So at least it's not a real negative in terms
Well, I
of
think
business
the
activity.
negative perception
Right.
is I think sometimes the fear is worse than the reality.
It's one of those things that I said, in spite of what goes on in Washington, and that's one of the things that goes on in Washington that we're sure not happy about, and I don't think
Yeah.
most investors are, or most business people. It's sort of like the unknown.
The uncertainty.
You're telling me to do this, but I'm not sure what, and if I hire 2 more people, then what happens to
Yeah.
what I have to do, and that keeps you from hiring. So again, that was very much a negative for at least consumer confidence and business confidence.
Yeah.
But I would say, and I've been in, besides banking, I've been in non-banking private equity business and all, with sort of riskier growth type situations and all. And I would venture to say that most small business owners, they're in a microcosm. They don't say, I am part of this whole big economy, whether it's Obamacare, or
Sure.
interest rates are high or interest rates are low.
Right.
I'm selling to my customers. I'm trying to, come up with new technology or efficient ways of doing business, add value to what I bring to my customers, take care of my employees, get better employees.
That's their
train my
world,
employees.
right?
Exactly.
Right there.
And there's some fantastic stories of very successful small businesses in terrible economies.
Sure.
And you really scratch
Sure.
your head and say how that happens, but that's the
They-
beauty of the American engine. That's the strength
Yeah,
of it.
exactly.
That happens.
All that considered, Richard, out the front windshield, what do you see? We've talked about how last year was a really good year.
It's a great look back, a look ahead.
What do you see? What do you see?
Yeah.
What do you see looking ahead?
I think, again, I don't like to get into the numbers that much,
Yeah.
but if the market's up 8, 10, 12%, it'll be terrific following the kind of year that we had. And barring anything that comes out of left field, and those things do happen, corporate earnings are good. The economy is improving. There's a lot of, you can say, hey, this is wrong, that's wrong,
Sure.
unemployment's too high. The real rate of unemployment is twice what you hear. It's probably all true. But as long as companies can be productive and consumers and businesses can regain more confidence, which they're starting to do, then they spend. And the consumer accounts for 2/3 of economic spending in the country for the GDP. Businesses create the jobs, small businesses on a big level, more than a lot of the real large ones. So, and productivity, technology is wonderful on every level. Whether it's some esoteric thing that I might not understand how this makes this more productive and that does that,
Yeah.
or that hey I have to have a new iPhone every 3 weeks or something like that. It's good for the economy, spending. I know all jobs are not here, but
Right.
And every time Apple makes a new phone, it's a slightly different size, and you buy a cover. I just bought an iPad Mini and paid $70 for a new cover.
And your
about
charger
this big.
won't work on the new one by
And
design.
nothing works.
It's
and
like
the,
it's
and the
silly.
cover's worth
Yeah.
$5.
Yeah.
I mean, they're worth it, but
Yeah.
But it looks nice.
so there's profits, and it looks nice when I drop it. It bounces. So.
How about the bond market? Do you still see troubles in the bond market, and how are you making yourself way through that troubled market? If
Yeah,
you
I mean, for a long time now, a lot of people, including us, have thought rates will go up sooner than they have.
Yeah.
The Fed really kept them down to almost zero. If you're a borrower, it's wonderful. That helps the economy. If you're a saver, you're out
Not
of
so
luck.
good, yeah.
And you're getting hurt.
Yeah.
But rates will start to go up as the economy picks up a little bit, as the Fed eases up on so much help a little bit.
Mm-hmm.
And so again, you don't want to get caught up in, if I have this lower quality bond, or if I buy a 20-year bond, I can do this. Stay with the quality, stay with a relatively short to intermediate term.
Yeah.
You're not going to be getting 7 and 8% coupons,
Right.
but you also don't have 10% mortgages. You can still get a mortgage for 4.5. So, just be wary, buy good quality, and stay, midterm, 3-4 year average maturity.
Right. Yeah, you're not getting, the yield advantage, you may expect. Can you get more yield for going longer? Certainly. But you have a lot more risk. Not
Right.
a little more risk, a lot more risk.
And you get your risk with your stocks.
And I think
don't
people-
do it with your bonds.
I think people need to be aware of that. Why do they own the bonds? Is it really just to kind of smooth out their
Right.
returns?
It reminds me of I'm a director of a nonprofit, and that we have a few $100,000 in the bank.
Right.
And recently we had a meeting, and somebody brought up, well, Mr. Mitchell, we have $100,000 in a money market fund at the bank,
Yeah.
and the interest rate return is 0.01%. Shouldn't we be doing more with that?
Yeah.
And I go, well, if we try to do more with that, we're going to take some risk, and maybe some significant risk.
Right.
And
Right.
I don't think it's appropriate. But it's such a temptation
Sure.
to make that stretch. Gee, can we
Right.
get 3%?
Yeah.
Then we have to lock up our money for 5 years.
Yeah.
And in 3 years, you're going to be mad because the interest rates will be 8%, and we're only getting 5%. And we cash it in, we'll take a penalty. So it's I'm a quality guy too.
Yeah, you have to stay with, if that's for liquidity, that's great. That's what you need to do. If you're a long-term investor and say, hey, I think I can be 60% stock, 40% bonds, that's
Yeah.
great.
Sure.
Your stocks will do whatever, but they'll go up over a period of time, and your bonds will give you stability, and down the road, some more income. And that stability comes in handy, especially in 2008 and a few other times.
Yeah.
Yeah.
Well, the other thing that, and I know, Richard, you and I have talked about this on previous shows, that, when you buy a bond or any fixed investment, it is that. It's fixed. You buy a 10-year bond at 3%, you're getting 3 today, and maybe that's acceptable. The problem is, in 10 years, you're still getting that same 3, and it's not going to buy as much milk and bread as it buys you today. Whereas with good quality common stocks, household names, people use their products and services.
You can get good dividend
You get
yields.
2, 3, 3.5%, and those dividends will grow or can grow. And many have 20, 30, 40, 50-year histories of that.
Right. And a lot of them grow their dividends 8, 10, 12% a year in a 1 or 2% inflation environment. But again, I think some people got caught up in, well, I'll just buy Coke and all these stocks that pay good dividends. Obviously, Coke could have one little blip there and go down 3 points,
Or
and there's your dividend.
some
But
of these-
again, you have to be long-term. So
Some of these very large banks that people consider them, was a widows and orphans type of stock. You can't go wrong, and my gosh.
Yeah, they did.
50,
yeah.
60, 70, 80%.
Right.
Yeah.
Decrease in value.
And again,
Yeah.
and along the way, dividend decreases or dividend
Yeah,
eliminations.
that can happen, yeah.
So,
Right.
you do have to obviously
Need to balance
so you have to
things.
stay on top of it
Right.
and make changes when changes are appropriate as things change.
Right.
How about as far as sectors? Do you specialize in any type of industry, or you have a pretty broad-based mix of your clientele?
Pretty broad mix. Pretty
Okay.
broad mix. It's interesting. One sector that I'm certainly interested in is technology.
Right.
And there you're talking about you're selling the company's selling an intangible, and then banks say, well, we want to have real collateral. I mean, if you're
Right.
selling an intangible, and the receivable is generated, the company owes the customer owes the company the money and stuff. But if this intangible doesn't perform to their satisfaction, maybe they won't pay and that type of thing. And 15 years ago, banks said, well, we're not going to do that type of soft type of financing.
Yeah.
Well, they do now.
Right. Well, things
So
change.
there's some
Things
changes
change.
there. And you got to know what's happening all. And it also goes along with banks doing what's called asset-based lending, where they're relying heavily upon the receivables or heavily upon the inventory and that type of thing.
Right.
The only way you can really do that is you have to specialize in that kind of lending and have very close monitoring, know exactly where the collateral is, how much there really is, and do your audits and be able to sniff out, what's really going on.
Right.
Because you're relying so heavily upon it. You can't just say, we're going to do it,
Sure.
and then find out that, gee, something went awry.
It didn't work so well.
And back to Washington and the heavy hand and the regulation.
That's right. You shouldn't be doing that type of stuff, and somebody else will be
regulation
doing it.
is good to some point, however.
Yeah.
You mentioned technology. Now I'm going to come back with a question for Richard on technology. But before I do that, I want our viewers to know we're always looking forward to your questions. You can send your questions in to us. You can mail them to Money Matters, 205 East Levering Mill Road, Bala Kimwood, PA 19004. Again, that's 205 East Levering Mill Road, Bala Kimwood, PA. Or you can email them to us, all one word, moneymatterstv@gmail.com. So we look forward to your questions, and we'll get you intelligent answers to those questions. Richard, let me shift back to technology, because I know, within your portfolio you have some good quality technology names. And I really would just look forward to your comments of how things really are changing, where, big technology was never dividend payers. They would always reinvest that growth, but that's changing. Some of the biggest, most
even Apple,
largest market cap companies are now paying and going on record that they're intending to increase dividends, like Intel of the world. You mentioned Apple, Microsoft, Cisco. Do you find that interesting, how that really dynamic has changed?
You get mixed messages. It's a good question because people say, "Hey, tech fast growing, they're reinvesting everything, they're growing leaps and bounds." And then when they say, "Well, we're going to pay this dividend," it's, well, gee, maybe they've run out of ideas, and now they're just going to pay dividends like utilities used to do in the old days.
Yeah.
And so, but if you can come up with a mix, and I mean, Apple, I think it's like $11 billion in dividends. These companies help the economy. So you can have a mix. Yeah, the hottest new stock or Twitter or whatever is not going to pay a dividend. Who knows what happens with the price or what the value is, what kind of earnings there are. You have to be wary of those, even though you only hear about the good stories on that or Facebook coming back.
Yeah.
But the Intels of the world, or Teradata, which is not quite a household name, but data warehousing company, and just companies need companies like that. Great products. F5, which is cloud computing. So a mix of companies like that, and the Intels, Microsofts, Apple, Google.
Yeah.
Google, even though it's priced at 1,100, but there are earnings there, and maybe if they did a 10-for-1 split or something, more people could afford it. So tech is always very attractive as far as just that it's such a growth area.
I'm intrigued to look at a company like Google and say, oh, wow, it's such a growth company and the whole bit. And its revenues are advertising. How old school is that? I mean, sure, it's a search engine, that's technology and that type of thing, and that's useful for society and all. But I sort of kind of smile at that. It's just advertising.
It's just a different way. And media companies had a tremendous year. I mean, I think that took a lot of people by surprise. CBS. I mean, what could be more boring than CBS? But the technology is changing everything and so rapidly. But it's nice. Sometimes they make this and here's what it is. And sometimes it's difficult to understand. Well, gee, what is it that they're doing that everybody wants?
Yeah. Are there any industries that you're less optimistic about, or really steering clear of? That
well, it depends on what you feel about the economy and consumer staples, which would be like Cokes and Pepsis and Proctors. I mean, they're wonderful companies that pay good dividends, get you a lot of overseas exposure. Like 60-70% of their revenues are overseas, and we think that's a safer way of getting growth in the rest of the world.
Right.
But they tend to have price-earnings ratios that are high for the dividends, for the pretty name, things like that. So investors need to watch that. There are times when maybe everybody doesn't like them. It's a good time to get in. Consumer discretionary in a better economy, like retail and such, can do well. Even a company, Hertz, is doing well. It's had its bumps, but along the way. But there are some retailers that had tremendous years, and healthcare, whatever Obamacare does to all of us, there's a need for healthcare.
Absolutely.
More every day. And healthcare had a very good year last year. It was one of the best performing sectors of the 10 sectors in the market.
How about energy, like fracking?
I mean, we tend to go with the bigger companies that may have an interest in it. Like Chevron and Hess, which has done very well. Occidental Petroleum. I mean, fracking is very exciting. There's always pure plays, I guess, out there with things like that. We go with the larger or mid-cap companies, and don't have maybe some $2 thing that does maybe become a success story or maybe not.
Yeah.
But fracking, even though a lot of people are against it, has made some booms in this country. And
less reliant upon foreign energy sources.
I mean, the whole energy story is very exciting.
I think in the
couldn't have been worse
area,
years ago, and now it's
back.
gotten bright. That's
I think in the energy space, and I know we've talked about it several times. Many of our guests have. In the energy area, especially where we're talking about a search and a yearning for yield, is many of these master limited partnerships. They're publicly traded companies. Some of them own thousands and thousands of miles of pipe. It's a pretty simple business. They own this pipe. It's all over the place, and they charge people a toll to push stuff through their pipe, whether it's liquid natural gas or oil. Some of them are very well managed, very diversified into what type of energy is going through that pipe. And I think that's something to consider as a way to get some yield in the energy space.
Talk about another investment vehicle, ETFs. What's going on with them?
I tell you what's going on with them is I go back to everybody's doing it. I mean, the growth in dollars in ETFs, and an ETF for our viewers is an exchange traded fund. Rather than typical buy a mutual fund or hire a professional money manager, an ETF is where you're literally buying baskets of securities, whether it's in the S&P 500 or in the energy. You can buy an energy ETF to participate in that. Big difference is they trade throughout the day, as mutual funds only are priced once per day. So if it's 10 o'clock and you see, not that we are advocating trading, but if it's 10 o'clock and you see the market starting to decline, you can sell your ETF at the 10 o'clock price. You can't do that with a mutual fund. But the amount of dollars going into this area is staggering. I mean, it's amazing how much money.
Why is that?
I think the biggest reason is it's cheaper, but I'd also warn people cheaper doesn't always mean better. You have to have a strategy that you're comfortable with, that works.
And you could name any subject in the world, and there's an ETF that does it.
Yeah, exactly. It
maybe too many subjects.
Exactly. It can be, it can be quite. Sometimes it's not as easy as what you see as what you get. It's an area that you need expertise in, and I would seek the advice and guidance of other people. So we've talked about a lot. I'm sure we could go on for another hour or so, but we're running out of tape here. So I would tell you I appreciate both of you being here. It was very enjoying. Hopefully the viewers enjoyed it. As always, your money matters. We appreciate you being here and your time and attention. Our next guest will be Mr. Mark Mulholland, who's a mutual fund manager managing the Matthew 25 fund. Look forward to speaking with him. Thank you again, and your money matters.